Hello everybody, this is Toni Turner and welcome to the market now as of about 2 p.m. Eastern on Friday, March 22nd. Well, Wall Street's main indexes are declining so far today after a raft of weak manufacturing data from the United States and Europe led to a yield curve inversion, which has stoked fears of an economic slowdown. U.S. manufacturing activity recorded its slowest pace of growth since June 2017. Germany manufacturing also contracted further in March, showing its lowest reading since June 2013, while factory activity across the Eurozone looks equally negative. And on those cheerful remarks, we will go on to three charts that could give us some insight into the week to come. First of all, we're going to look at our daily chart of the S&P 500 SPDR, symbol SPY. This is the exchange-traded fund that closely follows our S&P 500 benchmark index. Now, we know that since the SPY, the SP 500, practically every stock we know of, rallied off these big lows down here on Christmas Eve day, the next day on December 26th. Most everything started back up. We've had a very nice rally since then, and the S&P gradually flew back up to resistance, which came in here at about 280. So 280 to 2800 on the S&P 500. We saw in February the price poked its head up, tried to get over that resistance line. And by the way, that 280 comes in from back here in October, actually a little September, October. So these were strong resistance point here that these points at 280 or 2800 on the S&P could not seem to be overcome, certainly not before Christmas. And after we did take a few stabs at it in February, finally in March, the S&P did finally rise above the 280 mark, and I thought that maybe three closes above that line would give us some hope. It did rise yesterday. The SPY popped to a close to 284.73, certainly above that 280 resistance. But, and that was on the back of the Fed saying it wouldn't raise interest rates in 2019. Today, however, these reports on global growth I just talked about have taken the SPY lower. When I captured it today, it was trading at $280.38, or about 2803 on the S&P 500 itself. Now, again, we know that the SPY did break above the 200-day moving average, did break above the 280 line, but for the moment, at any rate, if the SPY keeps falling, certainly the Dow is lower, the NASDAQ is lower, almost everything is lower today except consumer staples and utilities. So if the SPY needs to come back down here, we have been trading in a range from about 272 up here to, we can call it 283. But if the SPY does come down here, if it does fall below its 200-day moving average, that's potential support at about 275. Then we have, at least at the moment anyway, potential support at 273. That's price support. The 50-day moving average is there as well right now, but of course that will change in coming days. Now, we did talk about the 14-day RSI and how for the greater part of March it has been riding up at the overbought line on the 14-day RSI. We've been talking about that. Last week I noted that the RSI here, you see where it was in February? It was up a little higher, and see where price was lower than it went to Thursday and a few days this week. So price went higher here. RSI actually made a slightly lower high. That's called a bearish divergence. And while it didn't really stick out and slap you in the face, it was evident on the RSI, and I told you we could take it as a slight warning. At any rate, again, the SPY is trading today at this point in time at 280.38. If it does continue to fall here in the coming week, and if it falls below right about 275, certainly below 273, I'm definitely going to raise some cash and become more conservative in taking on new long positions. So that's where we are right now. Actually, just looking at this chart, if you didn't know what was going on with all the announcements this morning, you would say, wow, we're in a really great uptrend, and we are. So there's no cause for panic here, but we don't want to give back all the delicious profits we've made in the last couple of months. Now let's go on to a chart that maybe not quite as happy. In Tony's Market Club, as I've told you before, we watch the IWM closely. This is the exchange-traded fund that follows the Russell 2000 ETF. These are the small caps. Small caps are valued at about $300 million to about $2 billion. And the Russell 2000 can act as a leading indicator for the broad market. Now, we know that the IWM fell dramatically in December along with everybody else. It did rally back up, and it rallied up to over its 200-day moving average here, then fell down. When I captured this chart today, the IWM was trading at $150.38 after climbing up to $159. Now, last week we talked about the IWM, and it was we talked about it forming a triangle, which it did, and we can take this line here. I'm not drawing a very straight line, but we can draw it down like this. So it was forming a triangle, and triangles, when they get this tight, they all obviously break one way or the other, and we didn't know, of course, which way it was going to break. Nobody knows that. However, the triangle broke today very definitely and fell. Not only that, it fell through its 50-day moving average, which is coming in here at 150.160. That's where the 50-day moving average is. Now, it hasn't been below the 50-day moving average since January. So right back here, it was below it back here in January, right around the 20th, something like that. So now it's back below it again. What I did notice, too, when we talked about the IWM last week, I was disappointed that the IWM did not return. Right in here we talked about it. It didn't return like the SPY did. It returned to its prior highs in this particular run. IWM didn't do that. It fell lower. It made a lower high here. And that was kind of a warning. And it couldn't climb back up to its 200-day moving average like all the other indexes did. And again, as the IWM can be a leader in the market, we need to pay attention to these things. Well, the weakness is evident now, and again, it's fallen below its support at the March 8th low, that low right there the other indexes had. But the IWM has fallen below that, again below its 50-day moving average. We've got the next level of potential support here where I've drawn this line. It's about 147, 148, where we have more potential support here. Now, as always, I'm going to be watching the IWM next week. I always keep it on my screen in a small chart to one side. Let's see which path it takes. It could come down. It could start rallying again. We don't know. But definitely keep an eye on it, as it could give us clues to the broader market's future direction. And now let's go on to a chart we haven't looked at in a little while, but it's like our favorite uncle. It's dependable and always there. We're looking at the top components we're looking at the Consumer Staples Select Sector Spider Fund, the XLP. Now, top components in the Consumer Staples Fund are Procter & Gamble's, Coca-Cola, PepsiCo, Walmart, Costco, Philip Morris. So if you will note today, this is one of the few sectors that did not look very, very unhappy as financials did and energy to a point. Consumer staples is higher, and that's because this is a go-to sector when the market looks dicey. That's also because a lot of these companies in consumer staples have low PE ratios and very sweet dividends. So it's kind of a go-to place when things look a little unnerving. So consumer staples we're looking at right now, again, symbol XLP. It, of course, came down to the December 24th lows. It bounced like everybody else, and then it walked up this trend line that you see that I've drawn here. Now, we could draw triangle lines here. The first one we could draw, the XLP came out of. So this one here we can draw, and the XLP popped out of that, unlike the SPY and some of the other ones, at least to any degree. So I'm looking here at the XLP. It's trading today at $55.20. It's the 50-day moving average and the 200-day moving average are right down here, and today it's known as a golden cross. The 50-day moving average is crossing above the 200-day moving average, and the 50-day is coming in at $53.57. So if the market continues lower in the next week, if consumer staples can stay above, hopefully, this trend line that I've just drawn, which is coming in now at about $54 and change, if the S&P sector consumer staples fund can stay relatively healthy and the market isn't going down too dramatically, I may add shares of this to my portfolio. I will put a pretty generous stop in here as it closed below the 50-day moving average, and I'm not going to buy too many shares. I'm not going to buy too many shares of anything till I see which way this market is going next. So we want to see if the buy the dippers come in the next few days, or if they don't. We want to keep an eye on that yield curve, of course, by keeping an eye on bonds. So let's see what happens. Let's remain conservative. When you're in doubt, get out and stay on the sidelines. So remember, stocks can't go up unless they go down first. The markets move in cycles. They do not move straight up forever, and certainly not straight down forever. So markets move in cycles. We have to know that. We've had a really good move in the last few months, and now maybe it's time to be a little bit careful here for a while. So on that note, let's go on to the coming week economic reports. But first, please join us this coming Monday, March 25th, for our next session of Toni's Market Club. If you join by this Monday, you will receive a really nice discount on your first month's subscription. And do please know there are no contracts and we don't have any cancellation fees. So if you're not sure how you can make money in the market right now, let us help. Toni's Market Club is held each Monday from 4:30 to 6 p.m. Eastern, and the recording is available to all of our members just after the session is over. This is a low-priced, high-value opportunity to learn how to trade more successfully and how to make more money in the markets. So please join us. For more information, go to the link on this screen or click on the button below. And now, on to the coming week's economic reports. On Monday, we have new home sales. On Tuesday, we have Case-Shiller, the S&P Case-Shiller Home Price Index, durable orders, and consumer confidence. On Wednesday, we have our usual crude inventories. On Thursday, we have the GDP, or gross domestic product, jobless claims, our usual jobless claims, pending home sales, and our usual natural gas inventories. And on Friday, we have consumer sentiment. Again, join us for Toni's Market Club this coming Monday. We've had some fantastic trades lately. That could be why we've been in business for so long. So don't miss out on this terrific opportunity to raise your trading skills and your trading profits, and save money doing it right now. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.